Good evening, everybody. 501. Let's get going for tonight. Long-term trading investing part two. Everything just seems to work out for me, it seems. I had on the schedule, on the calendar, I had an event last week, I had an event this week. I looked on the calendar at the beginning of last week and I said, why do I have two events back to back? That's kind of weird. So I just left it on there. And then, as it turns out, when I was writing the slides for last week, I realized that I just had way too much information. And I didn't really effectively get through it last week, and I actually got a record number of questions from you guys on stuff. So I just took that event that I wasn't sure if I was going to cancel, which is tonight. Actually, it was scheduled for Tuesday. I changed it to today, and made it part two, which that works out really nice because this should have been a part two from the beginning. I didn't really realize until I went through it all that this really was a two-night event because last week we went through an awful lot of stuff. And tonight we'll go through the second part. And I'm also going to answer some questions that I got from several of you that are on kind of two or three of the same questions to make it clear. And I have to apologize because it's probably my fault you had questions because I wasn't terribly clear on some things. Like I said, there's some things sometimes that I just think are so obvious and clear, but I forget that I do this all the time. And if you don't, it's probably a little not so clear. So long-term trading investing, review and analysis part two. My quote up there from last week as well, some people are able to day trade, but everyone is interested in long-term trading / investing. DTS is about the long and short term. This is a unique environment, and this session will cover everything. So this is a follow-up to last week's event as there was too much information. We'll look at some specific rules and ideas, blah, 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 and a lot more chart analysis this week. So first of all, I do want to remind you, if you weren't here last week, there is an event we already did last week, and I don't want to really repeat this, but last week I just kind of quickly covered the fact that trading to me is a generic term. It refers to any time frame I consider long-term trading to be what you might call investing. Just so we're not doing buy and hold. Trading means that you're using defined entry stops and management. We'll talk a lot more about that tonight. Financial planners are a good thing. I want to make that clear. Mutual funds are a bad thing. That's why 93% can't keep up with the market. It's not my opinion. It's just a statistic, a very accurate statistic. It's not even doubted or challenged. So there's no point in putting your money in something of which 93% can't even beat the market. And by the way, in a downturning market, they will lose almost as fast as the market as well. How the current economic environment of no interest rates has posed many problems for investors and how to handle that specifically. The one area that you should deviate maybe from your financial planner ideas because they are not objective or skilled in that one area, and that has to do with how you handle the market. We talked last week, and again, I'm not going to repeat this, but we talked last week about how your financial planner will view the stock market as a very risky thing. And it is how you should view it too if you don't have any training in it. But if you do, it does not have to be a very risky thing. I'm going to emphasize that more tonight because we didn't really weren't able to get into the details of some of that last week and why the market does not have to be a risky proposition, et cetera, et cetera. Let's continue with more information. And just in case for last week, if you want to see that, if you go to the home page and you click right there on that little free stuff tab over there, boom, right there, or you can just go directly there. And there's all kinds of information for you on this site, but specifically if you're looking for that event, it's under prior events, and the new stuff's at the end. So it's kind of like you're reading a book. New stuff's at the very end. So you go there and there's long-term trading investing part one. If you're interested in tonight, you might want to go through that from last week because that's some of the stuff we talked about last week. Now, let me first of all clarify something that again I thought was, well, I guess I didn't cover very clearly. I deal with this every day, so to me it was obvious, but I know a lot of you were confused. Let me explain what this meant. I expressed the long-term trader from last year, and again, it doesn't matter what you're talking about. The long-term trader from last year, I expressed how it did both in risk units and in terms of annual return. And it gets a little tricky measuring that because if you take your money and you send it to a mutual fund, you know, they give you an account and the fund goes up so much, they take out fees, you make so much. It's very obvious. But here, this is different. In order to get good returns, you are taking your money and you're putting it in to buy a stock in your account, either a stock that you have found or one that you got from somewhere or one that you got from me in a recommendation in the long-term trader letter, and then you are making profits on individual stocks. So what I was saying was last week that if you did this last year, that the LTT made 23.9 risk units. Now, risk units is a term I always like to talk about. It usually applies more to day trading, but it can apply to long term as well, which means that if you risked $1,000 on every trade, you'd make X amount of money. And then, of course, your percentage return would depend on how much money you needed in order to buy that stock with $1,000 risk. And that's what people got confused about. They're asking me if you, and I had a couple people ask this, how can you make that much money if you're only buying $1,000 worth of stock? No. So let me just give you an example here. Here's the 5 trades that are open, and you'll see this again, but I just want to take for an example to show you the math here, like on the Adobe trade here. If you take a look up at Adobe, it's in 3 parts because I sell it in thirds, and you can see the entry there. The point here is this: if you wanted to, let's say you want to take this position, let's just go from scratch, assuming you're just brand new, never even bought a stock. You're saying, hey, yeah, I'd like to make more than 2% of my bank account. Actually, you can't even get 2%. What do I do? Well, number one, you need to have an account where you can trade stocks. That is not hard to do today. You don't need any minimum to open an account anymore. It used to be, even for a regular long-term account, you'd have to have 5,000 or 2,000 or something. You can actually even use apps like Robinhood. I've heard are fantastic. Use your own due diligence. I don't use it. I haven't really looked into it at all. But you can open an account anywhere for no minimum money. You can send them $200, and there's no commissions anymore. There's 6 of the biggest name brokers don't charge commissions. Pretty much everyone is not charging commissions. So you can just open an account and do this very easily. In other words, there's no fixed cost to overcome. The money you make is money you make. There's no platform fees. There's no opening fees. There's just boom, whatever you make, you make. So that makes it nice. Okay, so second thing you have to do, you have to find a position. You have to find a position to play. Now, what I want to give you here, I want to give you everything that I can, but of course the thing that you have to figure out is what stocks you want to buy, and that's the whole, to me, the whole essence of what I teach and what I do is to teach people what stocks you go after. I'll give you some examples. But that little line here that says you need to find a position, that's a big deal. I mean, that's what it is. That's the whole key to this, is to find the proper stocks at the right time. And either, learn to do it for yourself, or subscribe to something like the long-term letter, or, give it a shot yourself. But if you're not doing well, don't lose money just because you're stubborn about getting help from somewhere. So if you're risking $1,000, the stop on Adobe here was $4.98. Okay, so that means you could buy 200 shares. Could I get a couple of yeses? Does that make sense to everybody? In other words, we're just not taking positions with no bottom to them. And you don't take them with this ridiculous lose 7% of your account rule that people talk about. So I'm going to say, whenever I take a position, I'm going to put up $1,000, like a bet, if you will, $1,000 bet. So that stop comes from the chart. It's not random. It's not just something made up. It's a specific area on the chart. When I say, if I get into this, if it goes under that, I don't think it's working anymore. So it's kind of a boom, got to go one direction only. So based on that, then you get your 200 shares. And Adobe's, a bigger stock. It's an expensive stock. It was 200 at the time. It was $270. But because it's bigger, the stop is bigger, and your share size goes down. So the equity you're putting into it is really not more than other stocks typically. The equity you put into something, in other words, the money it takes to get into the position, is more a function of the size of the stop, which is often more a function of the volatility of the stock. So you can eat up a ton of purchasing power, like trying to do IBM or something like that, because it's a $130 stock. And my gosh, you could almost take a swing trade on IBM with like a 40-cent stop. So you can end up with, huge capital expenditure. And the reverse of that would be like a $10 stock that moves $1 every day, because then you have a really cheap stock and your stop's going to be really wide. So Adobe is just kind of normal. It's a big name stock, but the stop is a little snug on Adobe because the way I did it. But it's the same as as what divide by 4. Would be a $70 stock having a $1 stop. That's pretty snug, and I'm going to talk about that, how I do that. When my long term, I really kind of go for the higher reward to risk stuff and let it play out. That's going to be part of tonight. So you'd buy 200 shares, okay? Now, if you buy 200 shares in, and again, I'm talking, all these numbers are in a standard 2-to-1 margin account. So if you do that, it would take $27,000 in equity. That's the money that you have tied up in order to buy the 200 shares of Adobe, okay? So then if Adobe were to go up to $350, which by the way is where it's at right now, it actually closed today at 351.76. That would be a $14,300 profit because you have 200 shares of something that went up from 271 to 350. That's about 80 bucks roughly times 4. So that's how much times 2 times 200. So that's about how much profit you would have in the stock. And then you want to figure your percentage. Let's say, just for simplicity, it took all year to go up to $350. That would be a 52% gain on the year on the capital that you used. Does that make sense? What Adobe actually did was, I mean, that's if you had it all year, right? If you had it all year and it went up that much. Adobe actually did that in 3 months. So on one hand, you could quadruple that gain. The annualized rate is 200%, but then also the whole thing isn't up there. I sold a third, sold a third. The average is about half of that. So just Adobe, the gain on that is about a 100% annual return. Now, that's an exceptional trade. That's my best trade this year. So that's obviously not what you're going to get. But you take that and then you throw in some losing trades, you throw in some small winners, and you know that. But that's how you figure this. That's what people were confused about and how you make the money. Okay, and what that said was, for the long-term trader, that if you took every single position, you would have needed about $80,000. Well, then you have to. That's the city. You have to adjust your risk amount for your account size. So if you have a smaller account, you may only be able to take a $500 risk amount. But that's what the next slide is, because the next question was, I made the statement that if you take a lesser risk amount, it doesn't change your return. And people thought that was crazy, but no, it doesn't change your return. So here's the numbers I just gave you on Adobe. If for a 52% gain, assuming these are the numbers, whatever, if you said, okay, well, I don't have that big of an account, I only have 50,000, and I only want to put, I'm not going to put more than half that into Adobe, 13,000 at a time, maybe 4 positions. So if you did that, your $500 stop, you take 100 shares, and your 100 shares would generate half the profit, but that half the profit would be on half of the capital expenditure. The percentage gain is identical. Does everybody get that? The percentage doesn't change. You're making X percent. Again, last year, with these numbers, the LTT made 30%. So you'd make that no matter what you have in capital. Now, it's true. What you have to figure is you have to figure an approximation what your risk amount should be to handle your account size. The average at $1,000 risk, the average capital expenditure. Adobe is one of the more expensive with 27. They ran from 15 to 27. It's in that range somewhere. So you have to kind of figure, okay, if I want to, and I define in the letter when you get the long-term trader, like for me, 6 to 8 positions would be maxed out. That's like the most it ever be. So I have 6 right now. So you kind of figure, okay, if you're going to have 6 positions, okay, I can only risk $400 per trade, whatever it is, okay? But thanks, Glenn. Okay, so the percentage you make doesn't change. I don't care if you have a $5,000 account. There are no fixed costs anymore. There are no commissions. There are no opening fees. So if you have a $5,000 account, you'd be making X percent. Your only expense would be, if you fund these yourself, you're still making X percentage. If you subscribe to a letter, your only expense would be the letter. Okay? So is everybody clear on that? Where do these numbers come from? This is very straightforward, upfront. No tricks. It's just math. And yes, the only thing that, if you were like to subscribe to the letter, the only little tricky thing you have to do is you say, okay, I have a $60,000 account. What should my risk amount be? And that's where you have to kind of, it's a little bit of a guess in there, but you can kind of tell from these numbers I'm giving you. Adobe's one of the more expensive ones. If you figured max like 20,000 of capital tied up per $1,000 risk unit, you can kind of go from there. And if you wanted to make sure you're able to have 6 positions open at once, then you can adjust your risk amount based on having 2, 3, 4, 5, 6 positions open at once. Now I don't always have them in the open. Many times I only had a couple open, 3 open. All right, so there's that, and that I thought was a very important thing to understand the money, how it works, how it flows, and again, I had a lot of questions on it. Okay, so are there any questions on that? I'm going to go to the next topic, which is more of a technical analysis type of topic, not a money or math topic. All right, here's the next topic. The next topic is this. If you go, here's Adobe, and I just showed you Adobe to now. There's 5 open positions, of which all of them were open since October, and there have been 5 positions. They all work. Nothing stopped out. Actually, yeah, the 6th one I took out back in September. So I had ATVI, and I have these other 5 open. But in between ATVI and Adobe, this is what I want to emphasize to you right now. So in other words, I'm looking at these through here, starting with Kimberly Clark down through here. These positions are not open. These are very short-term positions. I mentioned to you, like right now, the positions I've opened now, they've been the only 5 positions since October. So in 3 months, there's only been the 5. That's it. And no new ones like in 2 months. So it's very slow right now because I'm riding out the longs, which is what you're supposed to do. The market's been up, 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 up. I have long positions. I'm riding them out. That's exactly what you're supposed to do. But I want you to notice back in September, we'll look at a chart in a minute, but I want you to notice what happened here. All these positions were little gains or losses. Do you see this? Plus, minus, plus, minus, plus. Over here is the profit. So plus 800, minus 600, minus 1,000, plus 800, minus 6, plus 1, minus 1. If you add those up there, like break even or down 1 risk unit or something like that. Well, let me show you why that was the case. Why it is the case, I'm going to follow up on something that I started last week, and that was the fact that it's dumb to buy mutual funds. That's a statistic. And it's crazy to put all your money in the market to time it. And this is what, of course, your financial planner will say, and he's right. I'm awful good at timing the market. I'm just saying that boldly. If anybody wants to challenge me, feel free. I'm awfully good at it. I would not want to invest by taking my account and putting it in the market and out of the market. Does that make sense? I would not do that. Do you understand what I'm saying? You don't take your whole account and say, okay, there's the market top, there's the market bottom, here we go, right? I couldn't do that. Does that make sense for what I'm saying? If I can't do that, I'm not boldly say I don't know of anybody that can do it, right? I could probably do it. I wouldn't be comfortable doing it. How do you go to sleep at night taking your whole account and buying the market one day? What if it drops another day, 2 days, right? How do you sleep? How do you function? How do you properly manage it if you're down 4%, 5%? What do you do? This is just stupidity to trade like that. You don't do that. So we get our advantage. I use the market timing as like a shotgun approach, if you will, rather than taking a BB gun. And here's what I mean. I showed you this last week, and I don't think anybody got it. I was just kind of saying, as you run up, you unpeel some longs, and if you think you're at a maybe top somewhere, you leg into a few shorts. But naturally, if you're in a pure uptrend, you back off that. But when you hit a top that you think is the top for a while, based on your statistical analysis, if you hit that top where you'd say, well, if I'm a market timer, I'm going to put all my money short right now. Well, that's when you start piling into some short positions. Now, let me show you how valuable that is. That slide I just showed you where I had like those 6 positions that just went small win, small loss. Remember that, everybody? That's right through here. So I want you to show you what I mean by market timing. Here's the January low, okay? Right after Christmas, in the letter, I called this is the intermediate bottom, time to be long in the core account, right? Some of you get letters from me. That's what I said, no doubt about it. So I do that not by going long the market, but I took 6 long positions, stocks, between January 8th and March. So in other words, I'm playing this bottom with stocks, okay? Up, 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 up. We got to here, and I considered, let me draw a circle around it. I considered this time right through here the most difficult time in the last 3 years, right? So what I did here, if you can see right up here, I just summarized it for you. Right here, from here to here, I had all short positions. I think I had 6 and 1 long until I took the ATVI on until I took ATVI on September 3rd, okay? So I thought my market bias was short right here. Understand what I'm saying? Because I took mostly short positions. If I had taken my money and put it in the market, what would have happened? I would have stopped out, right? We're talking about long-term trading, so I'm not talking about, I'd have to go to new lows or something. So do you understand what I'm saying? That any attempt to play the market here, I was kind of wrong quote unquote in quotes because it didn't matter, but rather than playing the market short, I took stock short. And what happened as a result, so you can see this is right here through this time period, and that time period is this time period right here that I just showed you, right through here. And you can see what happened was hit and miss, hit and miss, hit and miss. Didn't really lose anything because of the way I did it, because some of the shorts made some money. Even though the whole market didn't fall, I picked the right stock at the right time. You can see a couple times through here the market did drop a little bit, so I made some money. So I pulled through this period of time, no harm to the account at all. And then in here, ATVI long. And then from here, then I plowed in all long. And again, the market letters people get said, time to be long. We're going to get into a power trend that's going to last until it stops working. Okay. Does that help explain, again, what I mean by the advantage we have to have this two-prong attack, to have look at the market and use a reasonable interpretation of where it should be going, and then to play it out through stocks that give us an additional edge? In other words, I can make money sometimes shorting a stock when the market's still going up. Does that make sense, everybody? If you pick the right stock, you can make money. And this is the great thing, is that like what we're in right now, where we are right now, we're running up, right? We're running up like crazy. Would you short the market right now? Anybody want to short the market right now? Anyone? Anyone want to short the market? No. If you say yes, I'm going to ask you, well, why didn't you short it last week? Or why not the week before that? Or why not the week before that, right? I don't want to short the market, right? When would you have done it? But you know what I'm going to start doing right now? I'm going to start picking on the right stocks to short. And I'm going to start doing that very soon. As a matter of fact, somebody out there getting the letter, right? I put out in the letter, the long-term trader letter I'm talking about, that I was going to short NTAP this day. NTAP was a perfect setup, absolutely perfect. And actually I put it out in the letter. Here's the little blurb from it. I just want to show you, right? I can barely read that because it's small on my screen. I like a couple of stocks short on the list, any acceleration in the market, or even a little mini breakdown, and I will take a couple. I may take NTAP soon. I like the setup. I will send a separate letter if I do that. Let's see what things look like. Well, what happened was, unfortunately, was that this is on this day here, on this morning right there, it just dropped like a rock. See, the market went up this whole day. So I kind of thought that with the market plowing higher, NTAP would just kind of hold. And if NTAP would just kind of hold inside that prior day and I had a little 2-day thing there, I'd use the low and high of those days as my entry. But it dropped. It just dropped. So I missed it because I didn't immediately react. I don't normally do that. And because the aggressiveness level with the market still going up wasn't really there for me, right? Why not short it now? If it's such a great position, why not short it here? If it's going to drop, Paul, why not short it, anybody? Why not just jump in? If it's going to fall, it's going to fall. Make some money. Well, I'm not too worried about the support level. The entry is everything. You don't do that. You don't just jump into something and say, oh, I'm sure it'll drop some more. I'll just take a little money. You don't just jump into things and take a little money. You find perfect setups. You get the right entry. And you play them for all that you can. When you miss it, you miss it. You don't start chasing stuff. Just even there. I mean, the entry I would have used, I wouldn't even know where to put the stop. The stop would have to be 3 times greater than it was, which means I'm going to make a third of the money, even if I'm right. That's not worth it to me. I'm not going to do that. So now I just have to wait. This may set up again with a different setup of some kind. Okay? As a matter of fact, that's the next thing I want to talk about are these entries like this. And again, this is a personal style. But my style in the long term, I look for very precise entries. Even though the setup is on a combination of the monthly and the weekly chart, my entry is often off the hourly chart. The hourly chart. Monthly chart, confirming a play. Weekly chart, having a strategy. All the way down to the hourly chart for the entry and exit numbers. That's what I've done on most of my positions. Most of them. Here's an example. This is the Adobe entry, just so you can see. And this is from... says they're back on October 28th. So here's 4 time frames. The monthly chart, there's the setup. Weekly chart, there's the setup. Daily chart, right in there. It was right there on the daily chart when you have a couple of flat top green bars there. And entry on the hourly chart. Over that hourly base, stop under that green bar. Hourly chart entry and entry numbers. Now what does that mean? It gives you a really pretty tight stop and allows for, when you have a really tight entry, so to speak. And I don't want to use the word small stop because that is stupid trading. But when you find the perfect area, and again, why all these charts? You see, the only reason I can play, let me ask you a couple questions. Why do I have the right to play an hourly chart long when I'm playing the monthly chart? Why do I have the right to do that? This answer may be very specific for some of you who are, somewhat familiar. For some of you newer, it may be just an esoteric answer, so to speak. But, well, now anybody can be the man or the woman. I still think women are better traders in general, by the way, ladies. The reason I have the right to find the entry here is because, yeah, EA has it, because of this, and because of this, and because of this. Everything from the top down is in alignment, where there comes a point in time where it should be boom, one direction only from now on, and that's what you want to wait for. So this is the concept of multiple time frame alignment, the most important thing to me that there is in trading. So when you have everything set up right, all of a sudden you can say, boom, I'm going to get very specific about that entry. What if you're able to find an entry like that and you take something that has a relatively small stop, like using the hourly chart instead of using, if I could have used the weekly chart, but my stop would have been about 4 times bigger, which means I would have made 1/4 of the money on the same move. What is the advantage first of using an hourly chart like that? What's the advantage of coming in here and getting that really snug little stop? What's the advantage of it? I mean, once you have it though, what's the advantage? Well, well, yeah, you may be in a little earlier, but what's the advantage? I want you guys to think about this because the next couple slides are kind of about this. What do you mean by risk, Ella? How do you define risk? I don't like using that term because you have to define it. Do you mean the amount of money that you're going to lose? Higher RR, right. That's exactly right, but I can't trade the hourly. Josephine, you can take the entry on the hour, like on Adobe you could have, because when you see the setup, this next day you put in an order to buy it over 271.86. It's nice if you're there to enter during the day, but all these recent trades, you did not have to be there during the day. The entry came such that you could have been at work and just put in other words, you knew your entry in the morning, and you could have put in the order, Josephine. So you don't, and that's the way I try and do it for everybody, because I understand a lot of people that get the letter, most of them are not with the market. So I try to make sure everything is done in a way that they can, do this while at work. Usually, I mean, 95% of the time, any kind of a position that I'm taking, I put out there before 8:30, so people can see it and they know that. There's only been a couple of times that I've had an intraday type thing, and one was because of locking a target. And it turned out it wouldn't have mattered because it didn't happen anyhow. So you don't have to be there during the day, and that's what this is long-term trading. So once you find the exact setup, this setup would have been something you could have done remotely the next morning, okay? Right, exactly. The advantage of doing this is that you make a lot of money because the smaller stop. Now, some of you, depending on how you trade, you may think a smaller stop means that you lose less money, but it's still the same answer, because if you lose half as much money on a smaller stop and you make the same amount, you're doubling your reward to risk, however you look at it. But for me, I always risk the same amount. But since I'm risking the same amount of smaller stop, I mean, let's say if the stop was half the size you would have otherwise done, you're doubling your share size, doubling your profit. So the advantage is more money, more profit. But what's the disadvantage? What's the disadvantage of using an hourly chart to enter a monthly chart? What's the disadvantage? Right, you're more likely to stop out. You're more likely to stop out. And there's another disadvantage, is that you have to be like at A-level chart skill. You have to know what you're doing on a chart. Right, Eric? You're not going to just pick up, a 20-page TA manual and decide and figure out how to enter something down 2 time frames. You have to know what you're doing. But even if you know what you're doing, there is that trade-off. Let me show you one other one, and then we'll go through that, because that little step is something I teach in classes that I want to go over with you. This is boring, but here's the same thing. This is Exis, which now Exis hit one target. This is entered here. I hit a really nice target, about a 4-hour target, and I still have the back 2/3 of this. By the way, Adobe, the last third is still open. I've been trying to trail it out, and it has been so nicely going up that it's hard to even get out of it. about a 15R last third. Right now it's, and actually, I actually put a dream target out there in the 250, in the 350s that we're actually maybe going to hit. I almost was kind of joking when I put the target out there, and we're actually very close to hitting it. So, that was a dream one. But here's Axis. This is kind of a more, typical thing. Axis, this is boring, right? Same thing. Monthly chart, weekly chart, daily chart. Beautiful little daily entry there. Monthly doesn't have to be beautiful, confirms the trade. Weekly chart, kind of the area we're looking at. Daily chart, really the entry here based on the first failed sell setup in the right area on the weekly chart. Actually, that failure occurred when the hourly base was taken out here. And same thing, you didn't have to be here. You get the letter the day before, says buy over this, could go to work, put your buy order in, boom, boom, boom. And there you go, using the hourly chart to get in this. And of course, here's that first pullback where, of course, this is where you're shaking when you take an hourly chart because you get that first retest and it's got to hold and boom. If you get the right entry, then it holds and you're golden. So this thing had a really nice pop. It hit target one and was just shy of target two, and then it had this gap down in here. Now, all of a sudden the stock gap down. This is not due to earnings. Why did this gap down that day? And what did I do about it? Really important lesson here. Why did it gap down, and what did I do about it? I still have the back 2/3 of this because I never moved the stop. So the stops, well, I didn't officially put it in the letter yet, but it's coming up to here. There was some news, I think. I imagine there was news because it gapped down that day. Well, everybody, here's what I did. When it gapped down this day, I went and I pulled up the news reports from 3 different news organizations and I read them from top to bottom. And I went in and I tried to understand exactly what the news was. And I said, well, the stock gapped down $14, but you know what? I think that really based on this news, I think that it's not going to fall anymore because I can understand the news better than anyone else. I'm just joking. Yeah, I'm just making that up. I didn't do any of that. I could care less. I don't even know what the news was. I didn't look. I didn't care. Didn't care. I let the news digest and settle down. And then the first time we resume buying again, I'll adjust the stop. So stop's going to come up to here, which is, just barely above break even, but that's okay. It hit a first target, the rest is break even. And now it plays out and erases that, or it does whatever. Maybe some other spot it may be sometime in the future the stop gets raised or whatever. So of course it's kind of a shame because it just came short of hitting target two for me, at least for me. I don't have it hitting target two. I don't think it did. So that's that. I mean, that's how I manage those. Again, this is long term, so I'm not sitting here staring at them. They're on my screen somewhere, so once a day I'll look at them, but I'm not even really caring what's going on. Okay. Now again, me personally, I like day trading. I like long term. I do not like swing trading. I've explained that to you. It's a very difficult time frame. It's distracting if you're day trading. I want something where I don't even need to look at these during the day. I don't even do it in the morning. Don't even care what's going on. Okay. Yeah, that's the problem, Eric, when you gap away from it, because it wouldn't matter if I raise the stop or whatever, it gap down. Just assume we're going to get there the next day, and then boom. But what are you going to do? Just part of it. Look at some of the lucky ones we had, though, right? I mean, this thing. Remember, like ATVI hit a first target like almost to the dime, and immediately just boom screams up to a first target, just hits it and then backs away. So I've had some good breaks on these too. You can't always complain about the bad ones. We've had some really good things that just, yeah, exactly. It happens both ways. So it is what it is. So there's that. Let me go into this. We're going to be down to 6 tonight because I made you guys stay here late last time. This is a follow-up. You have to understand that. Right, exactly. Exactly. So the style I've discussed often and teach. It is a trade-off that is the balancing act you always have to deal with in trading and investing in any time frame. I'm talking about what we just discussed when I asked you the difference between trying to sneak in with a snugger stop. And again, not a tight stop blindly, not just because you want a tight stop. That makes no sense. A tight stop just gives you more stop outs. But if you can find that super strategic spot on the chart where you have good odds of it holding, but you're able to use less, it can be a good thing. But that's what I want to talk about. That, in a sense, is a trade-off. And it's a trade-off you have to deal with in trading and investing all the time. And this trade-off never goes away. This trade-off is not something that you overcome through experience, or is not a trade-off you overcome through more education. the trade-off is always there. It's something, it's just a mathematical certainty. You can't help it. The trade-off will vary depending upon what time frame you trade and take your positions in, and on what time frame you decide to enter. Like I said, when I come down to an hourly chart from a monthly, or I do the same thing day trading. I mean, I come down to a 1, 2, 5 minute chart off of an hourly chart. You guys in seminars with me, you know that. So that's making a decision to go much more aggressive with the entry and the risk to reward. All these decisions you make are always decisions. Do you like to just generally have a tight stop or a wide stop? Do you like to use a bottoming tail before you enter or a little narrow bar? Um, just in general, are you okay stopping out and re-entering, stopping out and re-entering? Are you okay doing that, or would you rather never stop out? These are things that are all part of the balancing act. You have to decide how you want to trade. The balancing act is between how much you make and how likely you are to stop out. You could also call it the balancing act between reward to risk and your success rate. It's how much you make compared to how often you are right. It's your batting average compared to your Sharpe ratio. These are all saying the same things. Now, which is the better way to trade? Well, theoretically, they are the same in a sense. However, if you are good at finding those snug little entries, in other words, somebody without any technical expertise, somebody that doesn't know a chart really well, whether you decide, let me draw it here, whether you decide to come in here and just take, boom, take a buy setup on this time frame and have this wide stop, or if you decide to zoom down here and find some little entry and you have a third of the stop size, if you have no technical expertise, theoretically at the end of X time, you're going to be the same. You'll have 3 times more stop outs, but the winning trades will make 3 times more money. If, however, you have good technical knowledge, I believe it actually is an advantage to trade with the really snugger stops and let things run more. However, there's a big however here, and that is when you get a winner, you have to take it home. You have to take it to the target. You have to make money from it. When you get the home run, you have to get the homer. The problem people have is when they try this method, they take a stop out, down 1. They take another stop out, down 2. Then they get a winning trade, and guess what they do? They just dump it. It's the analogy like to Babe Ruth. Remember, a long, long time ago, I did a thing about Babe Ruth, right? Biggest home run hitter at the time, also the biggest strikeout king. Would you want him on your team? Absolutely. The home runs are worth the strikeouts. But what if every other time you had a home run, what if he just wandered off first base and went into the dugout and he didn't get credit for the home run? Well, now he's worthless. Now he strikes out all the time and he only takes advantage of half the home runs. And that's exactly what this is. Now, as a day trader, it is hard to do this. I do it sometimes, not all the time. As a long-term trader, I do this most all the time. What's the difference? The difference is psychologically, it's much easier to do this in the long term. You're not staring at the thing. To me, these long-term trades, you just put them away, you forget about them. You're looking to make a good percentage with the bulk of money. You're not trying to make your income every day. It's a different environment to me. Now, that's just a personal thing. You may not feel the same way. But to me, that's the way I do this. That's the way I trade the long term, is going for more aggressive entries. And that's why you saw, remember back in that March, April, May, June thing, where I showed you the chart was in a difficult area. I was taking shots. I called just take a shot, take a shot, take a shot, made a little money, lost some money, made a little money. But if we dropped, I was prepared to start making money. If we didn't drop, I'm still kind of feeling it out. And then, of course, by the time we were ready to go long, I was loaded. And that's what you have to do it to me, okay? Now, yeah, that too, Eric, exactly, because you have to have confidence that some of your winners are going to be real winners, right? Much easier the trade-off exists and will never go away. It's a mathematical event. The trade-off can be exploited the better you know the charts. Now, what I try to do for you here, guys, is just give you everything I can about long-term trading if you want to do this yourself. I mean, I've everything that I can in terms of how you do this, how you structurally do it. It's incredibly good, valuable information. As a matter of fact, in the when you look at the information about the long-term trader, if any of you did, if you go through that, in there you can click and get a sample letter from a while back, And at the top of the letter, there are rules. There are letter rules. And somebody emailed me that gets the letter and says, Paul, why do you give these to people? They told me that the rules at the top of the letter were worth the price of admission to the letter. How does that sound? The rules that I have at the top of the letter are worth the price of admission for the yearly subscription, even just to understand those rules. And I agree. The rules are gold. That is from years and years of experience. I'm talking about exactly how you handle certain entries, certain stops, and things like that. It's very, very important. But you know what? I said, I don't care. I want to help people with all the stuff that I can, but there's one thing that you still have to come to me to learn, and that is how to read a chart. Now, like I told you, if you listen to last week's stuff, I don't want to go through that again, but if you are interested in long-term money and in saving, investing for the future, in today's environment, to me, part of that has to be stocks. You just have to have significant stocks in there because that's all that makes money these days. And you have to do it the right way. And again, you have three choices. Learn to do it yourself by taking seminars. Subscribe to something, whether through me or somebody else, whatever you trust. Don't put it in mutual funds, but subscribe to something where you're buying your own stocks, somebody you trust. Or number three, give it a shot yourself. All I ask is that you give it a shot yourself, is that you be objective and don't lose money. And when I say lose money, you may be making money, but if you're not making nearly as much as you should be, don't make that decision just because you're stubborn, which a lot of people get to me. So let me show you just one more thing, because again, this is confusing to people too. I you know, should you pay for a letter? Should you pay something? Like I just said, you can learn it yourself, you can try it yourself, but if you try it yourself, just be smart. And I showed you this last week, just kind of showing you, because somebody asked me, Paul, does it make sense to pay for the letter if I have a $50,000 account? And I'm like, well, God, yeah, of course it does. I mean, it's like off the chart does. But I showed you this last week, which is if a letter made 10% and you made zero. And that's because I had this slide in another presentation from a long time ago. And people are like, well, wait a minute, why 10%, why zero? So, I mean, if you want it to make more sense, here, if the letter's making 30%, which is what it did in a 2-to-1 account, and if you're making 10 in a 2-to-1 account, well, it's a 20% difference. So now a $30,000 account, you could make 5,000 extra minus the amount for the letter, you net 3,500. So, you can do the math on all these. I'm just saying that, and there's no guarantee what the letter will make next time. But like I said, I am not likely going to be caught losing money when the market drops. By the way, here's something. I'm going to close with some market comments you guys are really going to like. You're going to love them. So your break-even account is 7,500. In other words, based on if you're making 10% last year, equally compared to the letter, 20% more, 20% of 75 is 15. You'd break even. So that's kind of your break-even account size number. And of course, who knows what the future brings or what they will be from year to year. Another question I had is I didn't start this full. This was the first full year for the letter. Last year was a partial year. I didn't start at the first year at DTS. I originally wasn't going to do it. I had some people that subscribed to old letters I did from another company. They just begged me to do this because they loved it. I went and did it. I started at an awkward time. I wasn't terribly active. It made only 5%. It was like a half year, whatever. I'm not sure when I started, sometime near a half year. So it made money, but I wasn't terribly active. Also wasn't terribly enthused about that exact time in the market. And then this year I got a lot more active myself long term and had a good return in it. Now, the other question I want you to think about is, okay, fine, the market's going up, the market's up, blah percent, and this is easy. Well, guess what? What's going to happen when the market takes a nosedive for the first time? As you know, I have had a long-term bullish view on the market for 11 years now. Unwavered, unstopped, never changed, never even discussed it. I'm going to start discussing it right now. There is an opportunity here if things happen right. It could be in the next 2 to 18 months that we're likely going to have a market top. It depends how it happens as to how precise I can be with it. My letter subscribers, of course, will be informed on a minute-to-minute basis if and when it starts happening. Right now, I can't say that it is. See, when you're looking at charts like this, it's not about predicting an event 2 years from now. You can't say, oh, 2 years from now I'll be in a market top. You just can't tell. It depends on how you get there. I kind of make the analogy. Here's the analogy for those of you that don't get it. Pretend you start in New York and you're driving to California, okay? And you had no clock, no phone, no calendar, and you were the passenger and you kept falling asleep and waking up. And you had to predict when you're going to see the ocean, the Pacific Ocean, right? And the first time you wake up, you have no idea if you might be at the ocean, you may not be at the ocean, but you look around and you see, oh, look at the great cornfields of the Midwest. We must be in the Midwest. I see signs that we're maybe a third of the way there, right? You fall back asleep, you wake up, you have no idea where you are. Are we at the ocean yet? You look around, don't see it. Ah, we're crossing the Mississippi River. There's another indicator to me. We're about halfway there, right? You fall asleep again, you wake up, you're going through the Rocky Mountains. You know what? We're not there yet. And I don't know how far we have to go, but I know we're kind of at the end of the journey. You know what I'm saying? That's what it's like with charts. You're looking at charts, and I can't tell you that, you know, July 23rd is going to be the high for the market. But in June, I might be able to tell you that the mid of July is going to be the high. So it depends how things go. I want to say two other things. There's a guy on TV who had it just 100% backwards wrong. 100% wrong. He was going through a scenario. The question was, what would you want to see for the market to have another good 2 years? And it revolving on politics, what he'd like to see. And he gave the perfect storm thing, blah, 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 blah. And what he gave was exactly backwards from what you want to see. Because if what he said happened, we would top out in the next few months, and that would be the end of the market. You want the opposite of what he said. You want to have a very difficult time. If you assume that the current regime is good for the market, and you want that to be the case, you want the current regime to have a lot of problems. You want the wall of worry. You want people to be fighting and scratching and to be a very difficult time. And then as your good result pulls through in a year, then the market starts grinding higher again. That's what you want to sustain the market. Euphoria right now will end this market. This guy had it completely backwards. It's the way everybody has it. I can see this stuff so clearly. It's just obvious to me. And I want to add one other thing, and I don't mean to say this to just kind of fluff stuff up because it doesn't matter. But I'd say a 50-50 chance. If the market forms a top a certain way, that this will be a top like we have never seen before. Like there will not be a recovery from this top in a long, long time. It'll be a long bleeding market. I have all the reasons why that would be the case. I'm not saying that's happening, and I'm not saying it's going to happen, and I'm not saying we're there now, but I'm saying there's a 50-50 chance that if this top forms a certain way, it'll be the end for, just like I said, this bull market would be a decade. It'll be the end for, I would say, 10 to 20 years. Meaning we would not even be looking at new highs in the next 10 to 20 years if it forms a certain way. And I have all the rationale for that makes complete and total sense to me. We're in a different world. And we ride it as long as we can. And for right now, everything's still bullish. So whatever you do, just remember, it's a different environment out there. You have to think about what you're doing with your long-term money. For those of you who are able to have some time during the day, I think learning to day trade, joining the room, even if you're free a morning or two a week is how you should start getting your toes wet. Not waiting until one day and jumping in 100% is the way to do it. Okay. So with that, it's 5 to 6. I'll stop here and let me ask you guys if you have any questions. There's some stuff I just kind of talked about. I talked about this last week. That's a repeat slide. Yes, Jamie, it will. Probably by Sunday. So you may see this video if you came late. And I really suggest you do. Like I said in the email invites to this, some people can day trade. It's the minority of people. It's everybody cares about the long term. And again, the focus on the long term is, to me, should be at an extreme fever pitch because you have no minimums in accounts, you have no commissions, you have no barriers, and you have no other way to make money. How do you make money these days? You can't take out a CD at 18%, 10%, 6%. You can't take out for anything. I mean, there's some cute things you can research that, there's municipal bonds and stuff like that have some risk to them, but probably aren't terrible. That's stuff you can look at, but I mean, the market still has, to me, a never-ending opportunity. And again, it's not just when it goes up. When the market falls, it's still the gold mine for making money. You make money when the market drops as well. And actually, it's a little trickier doing that in an IRA if you have to do it in an IRA. Other questions, guys? It is 6 o'clock, but I'll sit here and entertain any questions you want. Thanks, Mark. Hopefully this is very, very helpful to all of you. Just again, simply, I know a lot of you do it, want to do it on your own. Hopefully you really take a lot of this advice to heart. This whole thing about timing the market using stocks to me is just such a big deal that I hope it's helpful to you. It is to me one of the big keys, one of the big secrets, if you will. I hate to use that word, but all right. Thanks for coming, guys. We'll see you next time. See you guys in the room tomorrow. See you seminar people on Saturday. Have